I think Bitcoin earlier this year may have been struggling with some of the deleveraging that was happening for institutional investors.
Just selling what they could.
Yeah, selling what they could. And I think that suppressed Bitcoin, especially over weekends. But now that deleveraging is done, I think that Bitcoin is going to catch up to gold. And, Bitcoin's old high was over 110,000. So I think there is a lot of room to catch up as a sort of non-dollar asset.
Gold is on a tear, breaking out and pushing toward new all-time highs. But Bitcoin? It's been lagging behind, stuck just under that $85,000 mark. According to Tom Lee, there's a key reason for this divergence: institutional deleveraging earlier this year. Big players were offloading risk assets like Bitcoin, especially over the weekends when the market's liquidity is thinner. That consistent selling pressure has been a major drag on Bitcoin's momentum. But here's the twist. Lee believes that phase is over. The institutional shakeout has likely run its course, clearing the path for Bitcoin to not only catch up, but potentially surge past gold in the coming weeks. If you're watching this, don't just scroll past. Hit that like button, subscribe, and smash the bell icon so you don't miss the next big move in crypto. Dive into our other videos covering the latest in digital assets, and make sure to share your thoughts in the comments. Every click, comment, and share helps us beat the algorithm and brings this community one step closer to mastering the markets. Thanks for watching. Now let's ride this wave together.
When we were talking about Bitcoin sort of stuck under 85,000 with gold going up every day, and it was either you or Pump that said Bitcoin usually follows a couple of months later, but has a much bigger move.
That was probably Pump.
Probably, yeah. He's pretty bullish.
Yes.
Have you noticed anything similar to that? I mean, that's a pretty big move. And, in the past, gold's been leaving in the past near term, 2 months, 3 months, whatever, this year, maybe. We have seen gold leave Bitcoin in the dust and go to new highs. Looks like it'll do 4,000 easily, right? Do you think Bitcoin eventually catches some of the same money, the same bid?
Yeah, I think Bitcoin earlier this year may have been struggling with some of the deleveraging that was happening for institutional investors.
Just selling what they could.
Yeah, selling what they could. And I think that suppressed Bitcoin, especially over weekends. But now that deleveraging is done, I think that Bitcoin is going to catch up to gold. And, Bitcoin's old high was over 110,000. So I think there is a lot of room to catch up as a sort of non-dollar asset.
As for the equity markets, you think stocks are attractive, but uncertainty is still the name of the game, and it's going to persist. You think the high in the VIX, what did you say that was on April 7th, that holds?
Yeah, I think it's going to be hard to match that level of fear again. So I think we're probably past peak uncertainty. I mean, even with this Fed controversy, but I don't know if we're past maximum pain. I think that there's still risk that the economic consequences are going to cause markets to be hesitant, but it's going to be hard to match that fear again. So I think a structural low did take place.
So I don't know if I really think it's going to be hard to match. I could get a lot more. People were pretty fearful.
Yeah.
So you don't think this is going to be the absolute washout that some people are thinking, something similar to past breaks that were really significant. So let me ask you this, and just specifically, does the S&P have a closing bear market low from here? What are we down? 14% now, something like that?
Yeah. I mean, 4,800 was the low we made a couple weeks ago.
Yeah.
And I think that there's a chance we could be drifting dangerously close to that again in the next couple of weeks, because, there's still probably a lot of investors sitting on their hands and there's uncertainty. But on the flip side, I just think that we have to keep in mind that, one, companies are very resilient, and we'll learn about it during earnings season. But we could have a positive policy shock as well.
There was apparently...
What does that mean? Like a backing off of some of the tariff?
Yes, we could have something that the market sees as a win. Whether it's going to be one of the 15 countries that we have a trade deal with, or a de-escalation with China, which of course overnight didn't seem like that was a possibility, but there is room for a positive policy shock.
Apparently there's still another place where they trade stocks. Have I got that right? The New York Stock Exchange? Are you ringing the bell? there?
Yes, our company is ringing the bell this morning at 9:30.
At the New York Stock Exchange. We admit that we like them. But you're ringing because one of your ETFs has reached $1 billion, and it's called the Granny Shot
Yes.
ETF.
Granny
you
shots.
guys know what a granny shot?
Yeah, where you shoot from underneath from the basket.
Exactly. You can put more backspin, I guess, on the, and I
there
guess.
was a pro who did
Rick
that very
Barry.
well.
Rick Barry.
Yeah.
And they can get like 95%.
Yeah, NBA Hall of Famer, one of the best free throwers of all time.
Yes. So your granny shots are stocks that don't go down or impossible to go down?
Well, they do go down, but they're linked to the most important themes. So our idea is we identify like the most important themes that will last for 10 years, whether it's AI or cybersecurity or millennial structural things like that. But we find stocks that are strongest correlated to multiple themes. So it's a granny shot because you have more opportunities for that stock to work.
Lee's strategy has been so effective, one of his ETFs just crossed the $1 billion mark in assets, a milestone that earned Fundstrat the prestigious honor of ringing the bell at the New York Stock Exchange. That's no small feat, and it speaks volumes about the strength of their approach. Lee also dives into dividend strategies, emphasizing why actively managed ETFs matter now more than ever in a market flooded with passive products. He warns investors against blindly chasing high dividend yields, a move that often leads straight into unstable, high-risk sectors like oil during market downturns. Want to stay ahead of the curve? Make sure you like this video, hit that subscribe button, and turn on post notifications so you never miss out on smart, data-backed insights like these. Explore our other videos for deep dives into crypto, ETF strategies, and everything shaping the digital asset space. Drop your thoughts in the comments. We'd love to hear your take, and it helps boost the channel in a big way. Thanks for being part of the journey. Let's go back to the interview.
This is what you get. I mean, somebody needs to turn to the camera and tell the president to stop. I mean, he is messing with the foundation of this country. He's messing with the foundation of the economy. He's messing with America's place in the global financial system. Not to mention using the word loser. How does a president use childish phrases like that when talking about the Fed chair? I get that there's reasons to dispute or disagree with what the Fed chair is doing, but that kind of language, you just cannot and should not normalize it, Kelly. I just think, and I have one other point I think that's worth making. Where's Jamie Dimon and David Solomon and Brian Moynihan? Where are the leaders of our financial community calling on the president to stop this business about trying to fire the Fed chair? And you see what you get here in the markets, right? I think these people they're the leaders of the financial community. They have a ton at stake, and I think they have to step up and speak out.
I'm sure that that's a factor in it. I think, as your previous guest noted, we started this period with people complacent, with the market pricing stretched. And so probably we were going to have a downturn regardless. Do I think that the president has exacerbated it? Oh, I'm sure he has. Let me add that it's important to note the difference between the headlines and the actual wording of what people are saying. For example, on Friday, Bloomberg had a story that they called breaking news that Kevin Hassett had raised this issue. Well, it was actually raised by one of the reporters. What Kevin said was, we will continue to study this issue. Well, if you're continuing to study something, which, by the way, is the only answer anyone can give, I mean, you have to admit that studying it, you can't say you've stopped studying it because you're supposed to be studying everything. If the answer is we're continuing to study this issue, it's not news, and it's especially not breaking news. So I do think there's a little bit of overhyping and a little bit of almost fake news in the way it's being covered. I don't think that the president is going to fire Jay Powell. I think Jay will be there if he wants to be until next May. What the president said would be another example, is that his termination won't come soon enough. Well, let's think about that phrase. If the allegation in the news is that the president is going to terminate Powell, then how can it be the president saying his termination can't come soon enough if the president's just going to do what it can do? Okay. So the interpretation in the news is contradictory. I think where the law stands is that the president cannot terminate Powell for monetary policy reasons, but he can fire him for cause. So, for example, I'm being a little bit facetious here. If Chairman Powell were to go swim naked in the reflecting pool with 6 prostitutes, then I think the president would step in and fire him. But when it comes to firing him because of monetary policy, I do not believe the president's going to do it.
The dividend growth ETF that we offered was one of the first products that we launched back in 2020. And we have seen significant growth, as you mentioned. I think as a macro theme, income and dividend payment continues to see strong inflows across the ETF industry. For this fund, as you mentioned, there's kind of 2 things. Number one is dividend payment and income, but also longer term capital appreciation. So you do see that amalgamation.
So there's 2 elements to this.
There's 2 elements to this.
And we have to point this out. There's 50 different dividend ETFs that are out there. We have to explain this because people get confused. They're not all the same.
So having an active strategy then is kind of a differentiating point, because most of the dividend ETFs are passive and they're saying, all right, we're going to be the 10 or the 100 largest names growing their dividend, or the 100 largest dividend yielders, right? So having an active strategy, you're getting the dividend, and then you're also getting kind of a quality characteristic involved too, because the managers should know the stocks.
Yeah. So here's the difference. You can buy an ETF that just has the highest dividend payers on a percentage basis, which generally is not a good idea. We've said this for many years, because that could be in danger of cutting the dividends. For example, oil stocks. Then you have ones that have a consistent history of paying dividend increases, which is sort of what you're doing here, but you also have an overlay of capital appreciation too on top of that, right?
Right.
So there's sort of 2 elements here to this.
Yeah, there's 2 components, and I would go back to, I think, the differentiator for T. Rowe Price, and there's, I would say only a few firms that have the research capability that we have globally, and that bottom-up fundamental research actually drives investment decisions across our lineup of portfolio and the ETF
and
side.
What is the yield right now? Which I'm sorry to put you on the spot. I actually don't know, but it's probably 1.8, 1.9, probably close to 2%.
I'd have to double
somewhere
check,
right in that area.
It's not just about income. It's about income plus growth. This 2-pronged approach is what sets Fundstrat apart from the sea of passive dividend ETFs that often miss the mark when markets shift or fundamentals change. Tom Lee highlights that Fundstrat's edge comes from deep bottom-up research, powered by Troll Price's global team of analysts. This rigorous analysis helps them identify high-potential companies before the broader market catches on, giving investors a strategic advantage. If you're serious about building smarter wealth, don't forget to like this video, subscribe to the channel, and tap that notification bell. Check out our other videos for more powerful insights into crypto, dividend strategies, and everything in between. And drop your thoughts in the comments. Every interaction helps boost this content and supports our growing community. Thanks for watching. See you on next video.